Hi, I'm Pattu from freefincal. Today, let's take a look at the ICICI Prudential Alpha Low Volatility 30 ETF. What is it about this index that's special, if there's anything special, and why is ICICI launching this? Before we begin, couple of things. There's a time lag between the day of publishing the article and posting the video because I'm busy with my course, making videos for that and so on. I hope to get that done soon. Then this lag will get sorted out. Also, I should be able to post more Tamil videos. I need some time to think about what to post in Tamil, what to say in Tamil. So that I don't have time for now, but I hope to in the next couple of weeks. Before we begin, the equity mutual fund performance screener for August 2020 has been published today. You can go to the website, just go to freefincal, that's the latest post, or you can go to the community page. You should be able to see the link. So coming back to this, so this is basically a so-called multi-factor ETF, or basically it's a two-factor ETF. It will track an index called the Nifty Alpha Low Volatility 30 Index. It is a 30 stock index selected from the Nifty 100 and the Nifty Mid Cap 150. That is the top 150 stocks of the NSE in terms of market cap, and 50% of the weight will be based on the alpha of the stock. With respect to Nifty 50, and 50% will be based on low volatility. One good thing about some of the strategic indices is that they will limit the weight of each stock to 5% and not leave it free like a market cap index and have 10%, 12% weight to a single stock. So alpha is not excess return. Alpha is basically a risk adjusted return. So it's possible for a stock or a fund which has not bet the index in terms of actual returns, but if it has got lower volatility, it's possible for it to have alpha. So it's very incorrect to say alpha is excess return. It's not. It's a risk adjusted measure. It's a risk adjusted outperformance measure. I've talked about what is alpha and etc. in previous videos, given you the formula here in the post and so on. You can have a look at that. Low volatility here essentially means it is the standard deviation of the daily deviation and daily returns, standard deviation of daily price returns over the last 1 year. I have also talked about this. I have a screener for this and so on. A factor-based index, as by now many of you know, the regular readers should know, is basically instead of choosing stocks by market capitalization, they will choose stocks by some kind of active fund selection metric like low volatility, momentum, alpha, quality, value, blah, 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 etc., and so on. The advantage this is that it combines active investing with passive investing. Instead of just blindly choosing market capitalization based stock basket, this is more a metric dependent basket. That is, there's some kind of active stock selection metric in it. Of course, you may or may not agree with that. That's a different matter. There are different kinds of factors that can be introduced, and they are called smart beta for very various reasons. Some people say they are smart beta, some people say they are not smart beta, and so on. That's something that I don't want to get into now. So I had just published a few days ago before this a list of full factor based index ETFs and index funds and ETFs, and already ICICI has got a low volatility ETF with 111 plus crores, which is significant. Some of it should be from their own AMC. They must have created a fund of fund and put money inside that. They also have a value ETF of only about 7 crores. Now, ICICI is a very smart AMC. They are the first AMC, in my opinion, to have understood the change in tax rule. That is, the income tax government has now said, if a fund of fund invests in Indian equity ETFs, it will be taxed as an equity fund. So ICICI started, I think they have two such fund of funds which invests in their own AMCs, their own index fund, ETFs rather, I should say, and they could be creating a new fund of fund, or they should be able to push this product into their old fund of funds, ask their distributors to sell the fund of funds. So so it works for them. So they should be able to drive some AUM into it. A multi-factor ETF is one that index is one, or is one that uses more than one factor, obviously. So Nifty has got amusing multi-factor indices. It has got a alpha low volatility index. It has got a quality low volatility index. It has got it has got alpha quality low volatility, and then it has got alpha quality value low volatility index. All sorts of khichidis are available. I have a video called Index Investing in Options in India. You should be able to see it in the front page of the channel, and you can have a look at that. So the idea of a multi-factor index is that not all factors will work at all times. For example, if you take alpha will work when there is a bull market. Typically when there is a bearish market, sideways market, alpha chasing will not work, just plain alpha chasing. But low volatility chasing, low volatility investing as a factor has got very good durability. It works typically, at least in India so far, it has worked typically across market cycles. Of course, there are Siva from AFIW had shown some research on how it doesn't work in a what it is a low interest rate regime, if I recall right. If I may get that wrong, but in India that has not been seen. That kind of association has not been evident so far, at least from the data. But the point is that there may be some occasions where one factor will work, some occasions where another factor will work. If you mix them together, then you can counter this cyclical nature, and the spread in the returns will come down, and we will see that for alpha right below. So the problem I have with let me show you. Yeah, so let me see what alpha. So the NSE has got a alpha index. It's got something called Nifty Alpha 50. This chooses 50 stocks with the highest alpha among the top 300 stocks of NSE. Then it has got a low volatility 50 index. This chooses 50 low volatility stocks from the same 300 stocks. Now, if you want to combine alpha and low volatility, you should create an index which chooses alpha from the same highest alpha stocks from the same 300, lowest volatility stocks from the same top 300, combined together and form an index. No, what did they do? They combined alpha and low volatility, but they said they will still pick stocks from only half this stock universe, only from the top 150 stocks and not the top 300. Now, I don't know why they did this. Now, we can never actually show, because of this kind of construction, I cannot tell, on a comparable basis, whether adding alpha to low volatility or adding low volatility to alpha, however way you see it, has made any kind of difference. I mean, that is the reason why people cry saying this is all data mining, and so what is the need to reduce the stock universe? This is just baffling. Anyway, they published a white paper on these multi-factor indices, and they conceded basically that low volatility works across market cycles over the long time. Alpha works only during bull runs. So even before you look at the data, intuitively you can understand, if I am an alpha chasing investor, my returns will fluctuate a lot. If I add low volatility, that is, I am chasing alpha stocks with low volatility, then the spread in my returns will come down. But if I am a low volatility chasing investor, my spread will anyway be initially low. If I add alpha to that, then my spread will become higher. So it depends on which way you want to go. It's like adding, my favorite example, adding white to red. If you start from red, you will end up with pink. If you start from white, you will end up with the pink. So it depends on where you start with. What's your color preference and how you change it and so on. Alright, so the very, very important data is available for these indices from April 2005 or so, but the actual traded data, the daily market trading data, is available only from July 10th, 2017. That's the launch date of the index. So much of the backtest is based on data which is a backtest. The data was created by a backtest, and then you do return analysis of that data. So it's a backtest of a backtest, which is to be carefully understood. So if you look at a graph like this, the white line is the alpha plus low volatility, the green line is the low volatility, the yellow is the alpha, the bottom light blue is the Nifty 50. It looks like, oh, what an index, great, and so on. But you have to be a little careful, because you are just seeing one return data here from that to that. So if you look at the 5-year returns, the pink line is the Nifty. The white line is the alpha. You can see how much the alpha has been fluctuating above and below the Nifty during good times and bad times. Then the blue line, if you can spot it, I hope you can, is the low volatility 30, and you can see the low volatility means the spread between maximum and minimum returns are kind of low. And then the green line is the alpha added to the low volatility, and to some extent it has bet the low volatility during some sometimes, and sometimes it does underperform. If you look at this is the standard deviation, and this is the rolling standard deviation. You can see that the alpha has the highest standard deviation. Next is the Nifty, but if you look at the low volatility and low volatility plus alpha, they have significant lower standard deviation, and that's the whole point. They are for an alpha chasing investor, adding low volatility will reduce the spread in the returns. Of course, I have data for 10 years and so on, but you can notice if I just put it for 15 years, I only have like handful of data points for the alpha plus low volatility, which is the green here. The red line is the low volatility, white line is the alpha. The Nifty is in pink. Don't get too excited. We just don't have enough data about it. I mean, it can go anyway in the future. Generally, see, when you choose a low volatility index or low volatility stocks, which I have been talking about separately, then you are guaranteed of low volatility than the market, that is the Nifty. But when you chase alpha, you are not always guaranteed of more returns. Sometimes you will get, sometimes you will not get. That's the whole point. Even if you are chasing alpha from a stock universe, that entire stock universe may not have any alpha. So that's the whole. Then you're just picking stocks with the lowest of negative alpha. So in that sense, it may not help you. So again, standard advice with respect to such ETFs. Such ETFs have very low AUM. There's practically no trading done because they will be held by institutions. If they will be held by fund of funds of the same AMC, don't buy such ETFs. The only advantage from this ETF is you will get the stock portfolio from the fact sheet every month from the fund house. You can use it for your own analysis and picking your own direct equity portfolio and so on. Other than that, there's no benefit. Anyway, these NFOs are not to be considered for investing, but at least you can learn a thing or two from it, how the NSE operates, what is the fund house trying to do here, etc. etc. Bye bye.